Also with us is Charles Bobrinskoy, Vice Chairman and Director of Research for Ariel Investments in Chicago. Charles, let's start with you. And really a lot of focus, or I'm wondering if you think there should be so much focus in Washington, so much getting done there with the health care, with Tim Geithner talking, with the Dodd bill looming here on the horizon. Is that one of the reasons that we're seeing gains across the board, such a rally on Wall Street?
You know, getting the health care bill behind us does remove some uncertainty, and the market hates uncertainty. So, yeah, it's a net a positive. The final bill didn't include some horrible things that would have been truly negative. The Dodd legislation doesn't include some things that people were worried about. So net, it's clearly not as bad as some people had thought.
I wonder
hey, Charlie, let me...
Sorry, Carol, go ahead.
I keep doing that to you, Matt.
Please,
now you owe me. Now I'm going to take it. Charlie, let me ask you, though, because I was at an event yesterday, and people are looking at this health care reform and saying it's going to be higher taxes, and looking at all the reforms going on, and just looking at the deficit, saying there's going to be more taxes coming from Washington. That's not going to be good for the economy. It's not going to be good for corporate profits. When does that kind of start to kick into the investor mentality?
Sure, it's going to be higher taxes for you and me. It's going to be higher taxes for the individuals, for corporations in general, but it's not necessarily that much higher in terms of taxes on healthcare companies. So we're going to be spending about $1 trillion more on healthcare, and we're going to be taking out a little less than $100 billion of new taxes from the healthcare industry. So I would argue net, it's actually going to end up being a positive for healthcare companies.
I wonder about the, if you look over in Europe, the Greek situation seems to be getting contained here. On the other hand, there are problems, some say, much more serious in Spain and in other countries. Even if we get Greece contained, should the market really shrug off the entire problem? I mean, aren't the worst shoes coming yet to drop?
Well, compared to people thinking that Greece was going to go bankrupt a month ago, I think we're in a lot better shape than we were a month ago. You had a lot of banks that have big exposure to Greece who now aren't staring at a short-term event. They're staring at a long-term problem, and that's much better. So, yeah, there's absolutely lots of problems, too much debt around the whole world. But I think net, we're not in as bad shape in the financial debt, sovereign debt situation as people were worried about.
What do you think about the low volume, low volatility, or at least low VIX here? Does it concern you, or is it just the sort of grumbling, slow-moving freight train moving higher?
On the things, a list of things I'm worried about, low volatility is not even on the page. It's a huge positive. What's kept investors out of this market is volatility and risk. And now that we're getting lower volatility, people are putting their toe back in the water, to use that horrible cliche. So absolutely not at all worried about low volatility. It's going to be a big positive for the market.
Hey, what about fund flows? I mean, we've seen so much of that so-called money on the sidelines going into bonds rather than equities. Does that concern you? Because a lot of people are saying this could be sort of a new normal as far as where people put their money.
Yeah, these two issues are absolutely linked. The reason why the money stayed out of the stock mutual funds and was in bond funds was because of that volatility. Now, if we can get reduced volatility where people think that stocks are not so dangerous, I think you will start to see flows back into mutual funds. Unfortunately, the retail investor tends to chase good returns. So when we've had a great 12 months like the last 12 months, you're going to see more money coming into the market, and I think it's going to be self-perpetuating.
And Charlie, let me ask you, you said volatility and volume, the least of your concerns here. What are the most serious concerns out there? I mean, you've got the unemployment situation with Janet Yellen just came out and said doesn't look like it's really getting much better. You've got the problems of sovereign debt. You've got the specter of rising interest rates. Which is your main concern here?
Yeah, and just to be clear, low volatility is not a concern of mine. High volatility would be, but low volatility doesn't bother me at all. Yeah, I think the things that we are looking at are consumer confidence. We got those great numbers out of Carnival today, a stock that we own. Tiffany reported some great numbers. So the consumer seems to be in slightly better shape. And then we are watching those housing numbers very closely. If we could get a little bit better housing numbers, that would support the financial markets. There's still trillions of dollars of mortgage debt out there, and we don't want that to start trading down again. So those would be the two things I'd look at the most, consumer and housing.
Charlie, though, what about, Matt referenced some of those comments from Janet Yellen today. She says she's not worried about the current enormous deficit. She says they're transitory and recession-related. Do you agree? She seems to be kind of shrugging them off. Are they that easy? Are they that manageable in your view?
Long term, I think they're a big problem. Long term, I think it's the big problem that we're all facing. Short term, though, I don't actually think it is. There's just, on this one, I agree with Keynes. Short term deficits are stimulative. They help the economy. They help the housing market. So short term, I'm not losing a lot of sleep about the deficits.
And Charles Bobrinskoy, always a pleasure joining us from Ariel Investments.